So good evening. So we are going to go together through a journey, a roller coaster journey, where I'm going to try to share with you my passion for predicting extreme events. So I realize that it's going to be a tough journey for you. I would wish I could download my brain as well as I could, you could download your brain to me and we would share this fantastic experience. So I ask for your patience and your tenacity to walk with me through this experience. So why predicting earthquakes? Why is it interesting? So first, a little introduction about who we are. We are Homo sapiens, but actually, are we so wise? Not really. You know that. We are better characterized as Homo prospectus, according to works by anthropologists, like this book you see in the screen, who claim that actually our brain functions emotionally as a prediction machine. And consciousness is, in fact, for the most part, the generation of simulations about possible futures. Other works by neurobiologists show that actually our brain is a prediction machine that continuously predicts, compares, tests, reassesses its predictions. And this is called the memory prediction theory. So essentially, we are not aware often about it. We are prediction machines, and surprise, excitement, fears emerge when the real facts do not coincide with what we expect. So what we are going to discuss today together is, first, some description of a few real-time predictions that our group has done in the past to hit up and to, let's say, justify why I might be a little bit qualified to discuss with you what I'm going to present. And then I'm going to try to show you how a scientist walks through this problem, extremely difficult problem of predicting extreme events, by sharing some of the most advanced concepts and methods. There will be one, maybe two mathematical equations to give you a taste of what is going on. And then, toward the end, I'm going, of course, to revisit the predictability and what can be achieved in a various number of domains, including social media, prediction of success, earthquake, epileptic seizures, of course, financial crashes, engineering collapse, and so on. And toward the end, I'm going to try to project myself and shake your belief about what is at stake for the future. What are we facing as big challenges and what we can do about it? Okay, so let's start with some motivation of successful prediction that our group has done in the past, starting with this one. So I should first immediately tell you that I'm sure for all of you who are very intelligent, you are going to say, but he picked a few, correct prediction and he hides all the failures. That's the standard way people do. Of course, all this is scientifically done in a very systematic way. Everything is published transparently and so on, so the track record has been developed in a very rigorous way. So the story started in the 90s when I collaborated with EADS, now Airbus Industry, and we developed this methodology to predict critical pressure tanks embarked on the Ariane rocket. You see here the bottom of the Ariane rocket, through the measurement of acoustic emission, the little noise that a structure makes when it is stressed. I will come back to that. Another type of predictions, and we have done many of them, is of course the diagnostic and the forecast of the end of bubbles and the subsequent crashes. You see here example of the dot-com bubble on the NASDAQ collapsing in 2000, in March 2000, the real estate bubble in the UK, in the US, and the more recent bubble culminating in October 2007 as a precursor of the great financial crisis that subsequently developed. Other examples are prediction that we did for the oil bubble that culminated in July 2008, And at that time, we were really in this disagreement with Paul Krugman, for example, Nobel Prize winner in economics, who said, no, the oil price is high because of fundamental issues, fundamental valuation. And we're saying, yes, maybe, but there is a very significant bubble component, and the crash came later on. This also applies to non-Western markets, like China, where we are able to predict, and there are very nice stories, I don't have time to tell you, about how the whole universe of economists and financial hedge fund managers were against me in this prediction in 2007. The Olympic Games were coming, and they say, no, it's impossible that a crash will come, and it occurred starting in January 2008. The prediction was made in September 2007, and other subsequent events also were successfully predicted. More recently, you have heard about the COVID crash on the stock market, right? So you see here the collapse of the market, the US market or the European market, and you see in red these little peaks, which are our confidence indicators, indicating precisely that the subsequent behavior of the stock market is not sustainable and something is going to happen. So I'm going to elaborate on this in the future by explaining that actually when some event occurs, it may be a combination of endogenous maturation of an intrinsic instability in the stock market together with exogenous factors that combine to, and this is predictable. More recently, very recently, you have heard of the Silicon Valley Bank collapse, the Signature Bank, Credit Suisse problems, and so on. Actually, in our not public yet Financial Crisis Observatory, we had a very strong signal about the non-sustainability of the MSCI index for banking. Other examples apply to social media, to success of books, YouTube videos, theater movies, and so on, any activity which develops through success by word of mouth, click of mouse, by herding, by imitation, by social phenomena. And this is another domain of application where we have been very active. Earthquakes, last, the most difficult, last but not least, where you see here the ascending curve correspond to a technical measure of predictability, which is called the information game. So how much information is added by a successful prediction compared to the best existing benchmark. And our system is modestly, I would say, is the best in the world, but it's still far from being useful. This is earthquake prediction is much harder than bubble and financial crisis prediction, just to take this example. I will come back to that. Okay, so this is just to suggest that there's something interesting to speak about. Now, why do we focus on extremes? Well, we are shaped by extremes. The world is shaped by extremes. Earthquakes shape mountains. When you see a landscape somewhere, it is shaped by earthquakes. Of course, it leads to extreme destruction, losses, death, and so on. We care about it. Volcanic eruption, extreme events can have many consequences, including massive climate disruptions, including the massive eruption that could occur like 30 million years ago, 70,000 years ago, which have had enormous climate consequences. Also, earthquake leads to mountain collapse. They can also trigger by themselves, and they shape the landscape that you see and also lead to massive consequences. Similarly, when you live not here, when you live in mountains landscape, you have glacial collapse, which significant consequences. Hurricanes have huge effect, freak waves, forest fire, you have heard them in California, for example, or Mediterranean area. Droughts are extreme events of massive consequences. Floods, as you see recently in Pakistan or California this year. Soil erosion, you might be less aware of this as an extreme event, where sometimes, due to special meteorological conditions, you have several centimeters of soil that can be removed in one event or few events, while you know that the soil takes millennia to be actually replenished. So this is considered by environmental scientists as maybe one of the most severe challenges that mankind has to face, because all the life we know, all economics and what we eat is based on this much of soil on the surface of the planet. Of course, solar flares are occurring. And I mentioned here the Carrington event that occurred in 1859. If this event occurred now, it is estimated that the loss, economic loss, would be up to 50% of global GDP, right? Global GDP is $100 trillion. So it will fry everything we have on the planet. So this happens with a recurrence time of hundreds of years. We are exposed to these extreme events. Of course, asteroids, Big Bang is an extreme event, of course, probably if it existed, but supernova explosion are other type of extreme events which are from which we are very dependent on, because all our elements, or most our chemical elements, are catalyzed or created by these events. Now, turning to engineering and human-made structure, you have bridge collapses, you have traffic jams, you have blackouts, can be triggered by a hurricane or could be an engineering problem, pandemics. Okay, no need to extrapolate on these, bubbles and crashes, social unrest, conflicts, regional, global wars. But on the positive side also, we should speak about extreme events like creativity, inventions, discoveries. And why are we interested in these extreme events? I could speak for hours about this. Let me summarize in a few minutes, saying that these extreme events shape our world. I mentioned the shaping of the topology of the mountain by flood and earthquakes, but actually when you look at this list, if you can read the board here, they shaped humanity, they shaped the laws. For example, going back a long time ago, it is now widely believed that environmental event like drought was a very strong participant or maybe trigger of, together with the fragility of the society of the Maya, to the demise of this civilization, right? Then, for example, another big example, you can hear from my pronunciation, I come from France, French Revolution has huge impact for the shaping of Europe and the world in terms of nation building, the nature of wars, where you can see a really disruptive transition to a new type of wars in the sense of nations colliding together, while before the French Revolution, the wars was the affair of princes and of kings with much more limited deaths per wars. You had another example, much more tiny, the crash of October 1987, which before the crash, the notion that there could be such a risk was not on the radar of financial experts, of traders, of investors. As a consequence, for those of you who know what is an option, a derivative, the pricing by Black-Scholes, which means by the theory, was perfectly working. And since the crash, in the mindset of all the practitioners and the investors, the way the pricing has evolved with the so-called SMILE, it's a technical term, has changed completely the way these options have been trading. So one event changed completely the landscape of financial engineering, pricing, and trading. And I could go on with, for example, .com 2000 that led to this interest policy that led later on to the great financial crisis as a consequence of the bubble in real estate and the financial innovation, and so on and so forth. So the main point is that each time there is a great event, a great extreme event, a shock, we unfortunately react. We change the laws, our psychology changes, the mindset changes, and the next decade or so, the next century is shaped by these events. So this is a very strong motivation for studying events. And of course, we have more recent events like the COVID-19 event, which is an extreme event with very severe consequences for maybe decades in the future, as well as the recent war going on. Now, okay, having set up the landscape, let me start with discussing what is the problem, or what are the problems with predictability and prediction. I should say immediately that by choosing myself to do my career in this field, I did not take an easy path because most of my colleagues shy away from prediction. It's considered to be as is written here, Richard, the famous seismologist, said that, those who dare speaking of earthquake prediction are either fools or charlatans. And I think this characterizes quite well the spirit, the psychology of many of my colleagues, who think that either it's impossible, or it's too dangerous to do, or could have very severe negative consequences. So, when we speak about prediction, often we think about astrology, we think about all this charlatanism and so on. So there are a lot of sociological arguments and studies that show why people shy away from predicting in a rigorous way, in a systematic way. There is another class of argument against predictability, which is the so-called emergent argument. And this argument was put to the front a lot after the crisis of 2008, when you see a little bit the diagram here to give you an impression of the complexity of the network of interdependencies in the financial world, where you have different type of banks, different type of organizations feeding themselves each other with information or with this information. And the problem was not the fact that a bank might be insolvent. The problem was the bank were all connected together with the fragility being at the systemic level. So these complexity arguments suggest that the system that we are building are so complex that they are beyond our limited cognitive abilities. We built monster Frankenstein that are beyond our abilities. And the same argument also applies beyond finance. For example, for those of you who code in the IT sector, we know that actually it's impossible, it's a mathematical proof, impossible to show that a code, that a software is bug-free. Right? In the banks, which are supposed to have the best software and the most secure cybersecurity, they know that they have to work with bugs. Right? So we all have to work with this inherent fragility and inherent lack of predictability of the inherent weaknesses of the systems. Another argument against predictability is, when you look at the complexity of the world and how science and physics and all other natural science developed, mathematics also, dynamical systems, we discovered that, in the 70s, 80s, we could characterize the world with the concept of chaos. You see this beautiful butterfly, which is called a strange attractor, which is highly unpredictable long-term, has some predictably short-term. And then when you look at more complex systems, you have this concept of spatial temporal chaos, you have this concept of turbulences, turbulence, which is the complex flow that Leonardo da Vinci, pictured very nicely and was in his art and engineering piece. And you have now the science of complex systems. All this suggests that we are way beyond our ability to say anything coherent and useful for the future of these events. And even worse, when you look at the fundamentals of mathematics, there are impossibility theorems. There is this branch called algorithmic complexity theory, which states, in a kind of layman's term, that most complex systems have computational irreducibility. So it means that they're inherently unpredictable. And the only thing you can do is observe them, run them on the computer or observe them and see what happens. They are inherently unpredictable. And this is actually a modern form. Some of you may have heard about this. One of the most profound theorems in mathematics is called Gödel's theorem, who showed actually the impossibility of proving propositions that are probably true. Most propositions in mathematics are true, but improbable. So it's a limit of mathematics that now in the modern language is the fact that most systems are not predictable. So maybe I should stop speaking. Huh? So it's the end of the conference today. We can go back home and rest. No, there is hope. So this view of the lack of predictability is summarized in a cartoon. You have probably heard about it because it has been widely advertised by the concept of the black swan. I suppose many of you, how many of you have heard about black swans? Can you give me some feedback? Yes? Okay, some, okay. So at least half the audience. So my friend Nassim Taleb, had been very successful at promoting this concept, essentially saying, most extreme events are totally unknowable, unpredictable. And this is nothing but the layman concept of the unknown unknown. And the unknown unknown is not a concept from Rumsfeld, right, the guy from the US during the Gulf War. It is a concept that was introduced by the professor of Chicago, Knight, in 1930. Right? So the black swan, let me be frank, is a wrong concept. It's wrong scientifically, and it is dangerous because it allows people to wash their hands and it takes away their responsibility. The claim I would like to support today with a full set of arguments in the time remaining and evidence is that extreme events are better characterized by dragon kings. Kings, because of extreme, the size of the king owning a part of the country in the old days, and dragon, because of their special characteristic that make them knowable to some degree and predictable and diagnosticable. And by the way, I was today visiting Copenhagen. I was very happy to see the spire with the 4 dragons, protecting the old Bourse of Copenhagen. And if I understood the history correctly, so it was about having these 4 dragons indeed protecting the Bourse, which is, I think, a preconscious concept of what I'm going to talk to you about, because, of course, the Dragon Kings allows us to make predictions. So now, let me try to walk you through, sit comfortably in your armchair, some of the concepts that we have developed, myself, my group, and other scientists in the world, to try to attack this problem of predictability. How we can go beyond this fundamental mathematical theorem that states that predictions is impossible. How is it possible to go beyond mathematical truth? And I'm going to argue around 4 pieces of information, some toolbox. The first one is the concept of coarse graining. Don't look at the trees, but look at the forest. The second one is the idea that there's a miracle that happens close to extreme events. We call it a bifurcation, a catastrophe, a phase transition. There's a reduction of complexity in a certain way that is enabling us to make some prediction. And another concept I'm going to develop a little bit more is this concept of positive feedback or procyclicality, which is so important in my view. And last, don't try to predict all the time, identify the right time, the pockets of predictability. So let me take a very simple example to start with this first idea, the first concept of look at the forest, but not at the trees. There are about, so I try to estimate, from my computer, I think it's a bit more like probably 10 to the 30, 1 followed by 30 zeros, molecules of gas in this room. Each trajectory of each molecule is a complex billiard trajectory bouncing off our body. The complex surface of this room is the utter level of unpredictability. It's called K complexity after Kolmogorov. Each molecule is unpredictable. Think about predicting 10 to the 30 trajectories. So each molecule is like a tree, totally unpredictable. However, I can predict with the law that I've learned in high school, the law of perfect gas, ideal gas is called, or even a bit better, the Van der Waals equation, what are microscopic variables, like the pressure, like the temperature, and they are related by this very simple equation that you see. So the key idea is that if you want to predict at the micro scale, impossible, the impossible theorem works. If you want to predict at a large scale, it becomes possible to have some knowledge. We can go further in the argument, and this is quite nice. Probably you have heard about cellular automata a little bit, so this is a way of representing the world in a very discrete way. So in this place here, so here, does it work? Yeah, here in the left, you see essentially time going down. It's a line where it is spaced by cells, which are either white or black. And the future evolution, so it's a time t plus 1, t plus 2, is simply based on local rules. For example, if I am a black and I'm surrounded by 2 white, I become white. This kind of rules, right? Simple local rules. So very, very simple. And you see very complex organization appearing. And it turns out that this type of representation or models of complexity has a long history from Los Alamos National Laboratories with Ilham and von Neumann, and then the famous game of life of Conway, and more recently Wolfram, you know, the producer of, inventor of Mathematica software and others. And what we understood from this is that there are 4 classes. In particular, class C4 is the class of cellular automata that are able to be Turing machines. What is a Turing machine? A Turing machine is a machine that is doing universal computation of maximum complexity. Now, rule 110, according to a full classification by Wolfram, which is very simple. You see the rule shown here. It means that if you have a 1, 1, 1, the 1 at the middle becomes a 0. If you have a 1, 1, 0, the 1 in the middle becomes a 1. Very simple, just a table, lookup table of how a 1 becomes a 0 or 0 becomes a 1 and so on, is capable of universal computation, of reproducing any pattern you want. It is the ultimate machine. Impossible to predict, absolutely impossible to predict. It's a proof. This is the only case for which we can prove for a cellular automata that you have this level. However, we have the problem, the solution, with looking at the forest. Looking at the forest consists in saying, I'm not interested in looking at the state of each cell individually. I can look at some average. I am a bit myopic. I look from a distance, from bird's view. I took some local average. I'm not interested to know how all my cells in my body work. I want to know how my organs work, how my higher levels work. And this is predictable because when you apply these rules, this coarse graining approach, it's called a renormalization group approach, technically, the system, which is utterly unpredictable, becomes class C1, very simple, very predictable. So again, a fantastic demonstration. And this is actually a whole program. I consider it probably to be one of the most successful or the most successful program in all science, which is to organize knowledge by scale, saying that when you want to know a system, you should not just look at a given scale, but actually the true knowledge is to look from the microscopic to the macroscopic and see how the description changes as a function of scale, how the equations flow, really flow with a time, effective time, which is not the true time, it's scale, and this gives the real knowledge and the possibility to predict. So here you see in action, in figures, how this process can work a little bit. So it's very figuratively. Another concept that I need to walk you through is this concept of emergence. The whole is more than the sum of the parts. What does it mean? It means that if I take very simple rules, like the simple automata, I can have very complex behavior. Like, for example, a phase transition. This is illustrated on the right, where you see a bifurcation, where the evolution goes from the left to the right, and you see the progressive footprint of humans increasing, leading to a slow process, like the proverbial frog being hit in the, hitting a pan, not realizing the problem, and then suddenly something happens. And I would like to also stress the fact that, everybody is taken abash by surprise when a crisis occurs, when something changes, a rupture occurs. Because we are essentially hardwired to think in terms of trends, in terms of continuation, while emergence predicts the fact that when you have a progressive maturation, you can have a rupture, a bifurcation, and this can be actually characterized systematically. A good example, very, very simple example that you live every day, when you cook your pan to boil an egg, for example. Here I have a test tube where I increase the temperature. You see the progressive dilation, the water level increases, and what you see is that something is going to happen, which is not extrapolation, which is a phase transition to a gas, to a boiling. And the boiling is a very everyday phenomenon, it's trivial, but one water molecule doesn't boil. It is a collective phenomenon by many molecules interacting together that gives rise to this bifurcation, this phase transition, this emergent behavior, collective behavior, which is of the type we use in order to make prediction in the field that I mentioned before. what other concept are we using? One is, another one which I consider to be one of the most important theorem in mathematics is this reduction theorem. What does it say? It says, in a layman term, most systems are very complex, very difficult to predict. It's like I'm flying in the fog, in a plane, I don't see anything, but a crash is going to occur, and suddenly I emerge in the blue sky and I see the mountain coming to me. So it means that close to bifurcation, close to a change of regime, you have a collapse of the dimensions of the system, which have maybe billions of degrees of freedom, utterly unknowable, too complex, like the molecules in this room, and suddenly the dimension of the system reduces to a few degrees of freedom, which are hard, okay, it's hard to know, and a very simple equation that can be fully categorized. I'm not going to teach you this, but this is to show you that we have been able, the mathematicians have been able to classify all the different types of so-called normal forms that express this collapse of this reduction of complexity close to bifurcation. And this gives rise, indeed, to this idea that we should not try to predict all the time, it's a failure, but we should be able to characterize what are the diagnostic when we approach to this bifurcation, these transitions, and this is where there is this predictability. And this is a partial, I think it's my best list of all the early warning signs before this crisis, this bifurcation. The one I want to emphasize are endogeneity and reflexivity, and the finite time singularity that I'm going to explain a little bit better, and positive feedbacks. And the lesson, there is one lesson to learn here is about monitor trends, monitor, measure, and see what are the deviations from the trends. So coming back to the example of the engineering failure that I was mentioning at the beginning, you see here in the little loop an example of how positive feedback occurs. So for example, if a damage occurs, let's say some fibers of this composite system in the pressure tanks occur, then the force, you have 300 bars of argon stored in this. You know, this is to maneuver the satellite and the rocket in orbits. So it's high pressure, so very strong force. If some fibers break, it means that the remaining fibers have to sustain this pressure, meaning that the force on this fiber is increasing. If the force is increasing, it tends to accelerate the propensity for these fibers to break. So if they break, there are even less fibers remaining. So as the damage occurs, you see that you have a procyclicality, a positive feedback, a process that leads to more and more fibers breaking, and in finite time, the system is going to explode. This is illustrated by the graph on the lower left. So this is a very nice example of procyclicality. And another example at the level of a macroscopic dam event, this is the infamous Sayano-Sheshenskaya hydropower station collapse in August 2009, which led to 70 people dying with a massive rupture of turbines, several billions of repair. And you see here the curve showing the level of vibration of the turbines months before the collapse. This is actually a story that we have found in 500 or more global collapse, crises in all types of industry by humans, where people tend to ignore the problems. In this case, they were putting anti-noise and switching off the siren of the alarm of the level of vibration. So this is another message. Most catastrophes are avoidable. Humans choose not to listen to the telling sign. Let me shift to the positive feedbacks occurring on financial bubbles. The upper left graph shows you what is called Econ 101, right? The basic lesson of economics, which says that you have equilibrium, the price and the quantity that is supplied of any good is produced by the demand and supply in the market. And the key idea is as the price increases, the supply increases because the supplier can make money by selling at a higher price, but the demand decreases, right? And as a consequence, you have these two lines that intersect, and the intersection gives you the equilibrium price. And of course, the fact that as the price increases, the demand decreases because it's more pricey, you have less money for, or less buying power for something that is more pricey, is what is called negative feedback, right? It's a stabilizing phenomenon. Now, paradoxically, or surprisingly maybe, in many cases in finance, we see positive feedback in action. And positive feedback is illustrated in the other graph, showing that as the price increases, the demand increases. The supply increases also, but the demand increases. They don't cross each other. There is no more equilibrium, and we go through a bubble. Can you believe me that indeed the price increases and the demand increases? Yes, we see it all the time. For example, real estate. You see the price increasing. You are a young couple. You say, if I don't buy now, the price increase by 20% is going to be beyond my reach. So the price increase, I rush to buy. And even more, the next cohort is going to rush again and is going to push the price up. In financial market, in cryptocurrency, you see your friend having doubled, tripled his investment. FOMO, fear of missing out, frustration, regret. The price has increased in accelerated way. You buy, you want to be part of this opportunity. Right? The larger price, the larger the demand. You have imitation, herding, all these phenomena that are characterizing this positive feedback. And this, of course, as the demand increases, it pushes the price further up. These are the mechanisms. So in my scientific life, I have spent a lot of time trying to understand what is going on. And I found that contrary to everything you have learned in textbook in economics and in finance, there are so many positive feedback phenomena in economics and finance, while everything you learn in textbooks is negative feedback, self-correcting, mean reversion. And by the way, the crisis of 2008 was impossible in models. The dynamic stochastic general equilibrium models used by central banks could not even model what was going on. The money and the banks were not even modeled the models. So why did we spend trillions of dollars bailing things that were even not modeled by the decision makers? So there are many, so main message for you, many positive feedbacks that work transiently, give very strong excesses, and then there is a brutal correction, which is a crash, usually a depression, a recession, and so on. In finance, the positive feedback occurs through two main characteristics, simply. Stock price increase. If I am a bank, I sell you derivatives, options, it's called. My risk increase. If I sold you a call option, so I don't need to go into detail. I need to cover my risk, and the way technically to cover the risk is at the price increase of the underlying, I have to buy more of it to cover. The more the price increase, the more the demand, the more I have to buy in it. And this is, of course, pushing the price up even further, feeding the bubble. Another one is, of course, as I mentioned, the herding phenomenon, the social pressure. The friend of my friend buy a stock, my friend buy a stock. I have to buy the stock, right? I cannot resist. And then everyone buys the stock. This is the standard story, emphasized or amplified, of course, by social media nowadays. And we studied very carefully the cause of the great financial crisis in 2008, which is still reverberating today. You might not believe me, but there are very big consequences nowadays. And these are actually many sources of positive feedback in financial innovation, in outsourcing of risk, in fascinating factors like loans to poor, Freddie Mac, growth over capacity, moral hazard, and many others. So the main message is these positive feedback are everywhere, and they give specific signatures that are knowable. I told you I will show you a formula. So this is one of the formulas that I've been building a lot of my scientific life with many variants in order to develop a systematic methodology to use this concept I just alluded to you to put in practice on an operational basis, on a daily basis, monthly basis in our Financial Crisis Observatory, the predictability of financial bubbles and crises. On the left graph, you see the trajectory of the US real estate index. You see the price accelerating until mid-2006. And in blue, you see the return. The return is simply the rate of growth of the price. So it's like the logarithmic derivative, the rate of growth is the best term, I think. And what you see is that this return increases itself. Now, this is a key concept. Do you know that when you invest, let's say 100 in a bank, and you get 10%, right? Next year, you'll get 110. The second year, you don't get 120, you get 121, right? 10% of the capital plus interest is called compounding interest, right? And this gives rise to an exponential growth, right? The law of finance is exponential growth. This is the law of proportional growth, and this corresponds to a constant rate of return. A constant return, exponential growth. And this is something that nobody understands. My fellow economists have a hard time to accept this. A bubble is not a price that grows exponentially, because everything grows exponentially in finance. It grows super exponentially, meaning the return, which is constant for an exponential growth, is growing itself. So, and you see here in blue, the return was indeed growing, showing an explosive, but not in the sense of exponential, super exponential behavior. And on the right, you see the same thing with the concavity. If the growth would have been exponential, the price would have been a straight line on this curve. You see the upward concavity, which means that it is intrinsically unsustainable, and there is a very significant predictability. You see our prediction. You see the band of reliability of the bracket with which we were expecting the correction in October 2007. Actually, the great financial crisis was really knowable, really predictable. That was relatively easy if you were looking at the right indicators, which were all the bubbles and the excess debt and excess financialization, the mortgage-backed securities. Here I put a list in the inset of the graph of all the bubbles that developed during this period from 1980 to 2008. This is a period where, which was called the Great Moderation by the 99.9% of economists who did not have a clue. During this period, you can see the graph of GDP growth, which is in this period extremely flat, low volatility, predictable, and so on. Similar for inflation, similar for unemployment. And this was called the Great Moderation. This was the period of 25 years before the Great Financial Crisis, where Nobel Prize winners were claiming that the word recession should be removed from textbooks. That it was thought that the economic beast has been tamed because of extraordinary performance of the economy at a level unheard of before. According to analysis, we were seeing bubbles everywhere, and this was not on the radar of the economist. Some see it coming, very rare, and they were focusing on the finance. So, I have walked you through a number of concepts. I want to augment the toolbox by extending the application to the other fields, like earthquakes, like epileptic processes of word of mouth and social successes, like the brain function, epileptic seizures, or like even uterus contraction and the prediction of parturition, the act of giving birth. You see at the bottom the signals in all these fields. For example, an earthquake recorded by a seismograph, or what is this? I cannot see. Yeah, the financial returns. The financial returns, yeah, or the epileptic seizure recorded by electric signal on the brain, or again, electric signals on the surface of the uterus muscle of a pregnant woman. So their analogy are really exceptional. For here, the top graph shows seismicity in California over the same period. At the bottom graph shows financial volatility. Financial volatility is a measure of the amplitude of finance. You have remarkable analogies, which are, for example, the concept of main shocks, foreshocks, aftershocks, that works for earthquakes, but also for seizures in the brain. And what we have found, and others have found, that the best model, the best theory to account for all these phenomena in all these diverse domains of application is essentially the class of epidemic processes, where you have an instantiation, a nucleation, an immigrant, it's called often. So we start the process, and there's a cascade of, let's say, earthquake. One initial earthquake triggered a whole set of other earthquakes through the branches that you see figured. And this also applies to success in social media, or to the way the cascade of neuron excitation occur in the brain, or the way how the muscles paving the uterus connect each other through gap junction and trigger a global contraction. And this gives rise to very good, actually, prediction, as you see here, for the global rate. This applies to epidemic of social economic networks, YouTube views, book sales, and financial shocks through the description of universal laws of how people react to piece of information, connect to each other, pass this information through various social networks, and so on and so forth, discussing. This applies also to very short timescales, like the famous or infamous flash crash. I don't know if you remember, in May 6, 2010, the Dow Jones lost almost 10% in 5 minutes. 5 minutes, 10%. Right? And then rebounded. You see here on the upper graph. And you see the volume was really exceptionally high and so on, so many metrics were very bizarre. And on the left, you see another event of a similar magnitude, which occurred in April, just a few weeks before. And there is a big difference between the two. The one on the left, April 27, was the first announcement to the financial market, and the traders reacted to it very violently about the fact that Grexit was possible. Grexit could occur, and it could be the beginning of the demise of the European Union. And the market reacted. You see there was a big drop in the financial market. And the main point I want to make here is that the event of the crash of May 6 was a very different type, no news. It was purely endogenous, and this is reflected by the fact that the bottom graph here, if I can see I cannot see. So the bottom graph here, you see the red arrows show on the right that an indicator of endogeneity, the level of triggering of this epidemic process by which traders make action based on the previous action of other traders, so really an analog epidemic process was very high, giving rise to the possibility of early warning. And we have developed this for central banks in different countries in the world because they wanted, of course, to control the possible instability of high-frequency trading. This concept also applies to parturition, to act of giving birth, where, not surprisingly, for the ladies here who have had children, you will not be surprised that, of course, you have this flickering of Braxton Hicks contraction at 7 months, 8 months, and then when everything is ready, you have this transition to coherent global oscillator that push the baby, and this is really a phase transition itself. We are working right now to use this concept to predict and diagnose preterm, and we have great advance in this domain, but that's another story. So I would like to use a few remaining minutes to project in the future and to share with you, integrating all the knowledge accumulated over the years, decades, how we can understand the world from a global geopolitical, economic, financial, democratic way, and what are the decades ahead of us. This is a very hard exercise. I'm aware this is very open to criticism, but I think it's worthwhile to do. We have to have the courage. This exercise, actually, we started with Peter Cowell, one of my collaborators, when we tried to understand the deep roots of the 2008 crisis, the great financial crisis, the largest crisis since the Great Depression. And we discovered, to our surprise, that we had to go to 1870 to understand the roots. And we actually developed a kind of history, and economic history and geopolitical history, where we identify these 6 regimes. The first regime covering roughly from 1870 to 1910, which we can call the Gilded Age, like gold on the surface. It's has many characters, and it's based on analysis of many economic and financial data and democratic data. This was followed, of course, by a big shift, which was covering the 2 world wars, ushering to the Golden Age. Golden Age, World War II was great destruction, catastrophic, of course, number of deaths and destruction, but it was the greatest invention and innovation effort ever. We are so good at inventing in order to destroy each other, unfortunately. And indeed, the private sector profited enormously from World War II, And the 30 years that followed were essentially the conversion of the military invention into the private sector. It took 6 months to create one fighter plane at the beginning of the war, 1 day at the end of the war. 6 months or 3 months for a navy, 1 week at the end of the war. All this management performance were transferred to the civil sector with extraordinary productivity gains that gave this 30 glorieuses, as we say in France, these 30 years of glorious, not only reconstruction, but extraordinary development of the wealth of Western countries and the world. And then, this was not sustainable. Why? Because efforts in productivity gains, effort in invention and discoveries and innovation was not sufficient. And what happened from the 1980s, the growth, we call it the fool's gold age. Right? This is the spirit mineral that looks like gold, but it's not gold. Don't take it as gold if you are buying gold. It's full gold age. This is a very good term to characterize this epoch because the growth of this period until the Great Financial Crisis was bought by debt and finance. 2/3 of the whole productivity gains of all industry was in the sector of finance. Very great innovation to invent all types of diversification risk. Where are we now? I propose we are in a next great shift, shift 3, which is characterized by over-control with an illusion of zero risk, the big issue of energy replacement, the de-dollarization possibly, which is a big destabilization factor, and transition to a multipolar world, and possibly with a new regime of economy of scarcity. By the way, more than 20 years ago, I was very much criticized at the time. We made a prediction based on 2,000 years of demographics data, GDP data, and 200 years of financial data, showing that notwithstanding the acceleration of the Industrial Revolution 1, 2, 3, and now we are in the 4th Industrial Revolution, this is not sustainable, and we are going to transition to another regime, not a crash, another regime, different, where we have to adapt around 2050 plus or minus 20 years. So essentially we are in this starting of this great transition, and this was something that now is, of course, resonating with works by colleagues in environmental science, climatologists, and so on, that suggests indeed that we are approaching here, in this case, a cliff, a transition that could be very bad or very good or different types, where we need to adapt because all these environmental factors and economic factors signal indeed the approach to this visibility of the transition and the predictability. So what could be the characteristic of this third shift? The characteristic, of course, you know them. In Denmark, you are very safe. You have very low debts, but most of the world have a debt to GDP ratio largely larger than 100%. Japan, 270%, Italy, 170%, and this is nowhere seen in the history except even less during wars. So it's not sustainable. It's a very big danger of instability, leading to a sequence of really inadequate management. COVID-19 has revealed what I think is a very dangerous problem, which is the zero-risk society, which is also something that a number of philosophers have actually developed. You know, for example, this Italian philosopher calls it the, Yes, the permanent exception. Another French philosopher called it the spirit of terrorism. Before the Great Financial Crisis of 2008, we did not have really the concept of systemic risk, meaning the global system is at risk collectively. Now, every little blips, we call it a Lehman moment, Lehman Brothers moment, right? After the name of the bank that collapsed. And this zero-risk society, this obsession to remove all risks, has extraordinary bad consequences because it stifles any entrepreneurial spirit, because about being an entrepreneur is being able to take risks, to be wild, And this is, of course, because we are aging society, so risk aversion. We have the social media and social contagion that amplify the problems. You have media as merchant of attention that emphasize extremes. You have illusion of control at the technical levels, and you have increase of inequality to unknown level. So this shift is also characterized by the transition to a bipolar world with, the China, US competing empires. And of course, another transition that we need to be aware of is the digitalization of the world, in particular with the digital currencies and the central bank digital currencies, which is essentially a path towards emulating China and the control of China. We have the energy transition. You have heard all about this energy transition. You live it here in Denmark very optimistically and favorably. It's not a transition. The correct word is replacement. We have to let go tens of trillions of dollars or euros of investment over hundreds of years to let go, to destroy, if you like, to replace by new type of energy production. I'm not saying we should not do it. We should be aware what are the consequences, which are enormous. The curve that you see here in color is that the history of mankind has been one of energy addition. China emerged from a GDP per capita of a few $100 to nowadays $15,000 by tripling its energy consumption. The energy that we consume in 15% of the human population, right, is many times larger than the remaining 85% of the population. India, 1.4 billion, needs to triple, quadruple, quintuple its energy consumption just to make a little bit of progress towards us, our standard of living. Let's not speak of the soon 1.82 billion African, which are way below. So we have to take into account this transition as an issue of not adding energy, which is massively needed, together with replacement, with investment of tens of trillions. I have been very sad also as a student of the consequence of the financial crisis of 2008 by saying that the policy making has led to the impoverishment of 90% of the population. The middle class in the West is progressively euthanized, disappearing. And the policy that we see now are actually not improving this. We have now transitioned also to, I think, a secular inflation. And this is another conference to explain why there was no inflation after the money printing of 2008 and to 2020, and now where we are shifting to a secular inflation. And of course, the big risks are social instabilities, demographic backsliding transition, and so on and so forth. So what I've been trying to tell you is, notwithstanding the complexity of the technology that we are inventing and the nature we live in, there is a possibility to know something about crisis, about extreme, about phase transition, catastrophes, when there is a bifurcation, a change of regime. Because the key idea is, there is maybe a sentence that characterizes what I've been trying to tell you. All these crises result or follow a slow maturation towards an instability, towards a field, a preparation that makes the system susceptible and fragile to different perturbations. So it should not be a surprise. I'm not saying that we can precisely predict, but we can actually diagnose that there's a problem and bracket to some confidence a time scale. So I put in red some positive conclusion. There is a fact, and I have spent a lot of work with my students also documenting this. The good news is that at times of difficulties, of crisis, and we are in this shift 3, this is where, for 10% of the population, roughly according to our estimation, these are great opportunities, right? So unfortunately, this gives rise to even more inequality. But if you are a risk taker, you are prepared, you think out of the box, you don't follow the herd, this is where to go in order to be able to survive and do better. Now, I would like to finish with a personal incarnation of the whole philosophy emerging from this view or this understanding of the complexity of prediction, which is the concept of dynamical risk management. So you can see 3 of my loved motorcycles. The red one I'm sitting on accelerates faster than F1, goes to 320 or 40 kilometers per hour. The top right is called the king of the mountain, so extreme motorcycles. So I am supposed to, I'm teaching risk management, I'm supposed to be a risk expert, I'm called to consult in many parts to give my advice. And I have students, some often, and they see sometimes that I drive this motorcycle, and they say, Professor, you are an expert in risk. Why do you drive a motorcycle? Right? It's well known in statistics that it is the most dangerous engine. Right? You are very vulnerable, and so on. And I tell them, yes, okay. So I'm a bit maverick, maybe, but actually, this is an incarnation of the following idea. Most of risk management, most of policy making is using what I call passive risk management and reactive risk management. What is passive risk management? Carrying an helmet, taking covers, protecting yourself. Clearly, as a driver, as a pilot of a motorcycle, I put them, of course, but I never want to use them. If they are useful, it means that I've crashed. What I want to do is to do dynamic risk management, predict. So I don't drive a motorcycle, I pilot a motorcycle. I want to predict the surface of the road, if there is oil, if there are pebbles. I want to predict the behavior of the fellow drivers. If there is a car even going at a red light, I don't want to be right in a wheelchair. I have to predict everything when I drive, and this is called dynamic risk management. This is a fundamental concept that is missing in the whole world to actually carry the level of mankind, let's say, control of the complex system we're building to a level that should suit Homo sapiens. So I hope I've been able to pass on a few of my excitement and passion, and I would be happy if there's any question, clarification to answer to any of them. Thank you.